You know the feeling? You open an email or maybe you unfold a crisp, formal letter from your bank.
Yeah, that stomach-dropping moment.
Right, exactly. Your eyes immediately scan down through all the pleasantries to find that one single word, denied.
It's rough. It really is.
It is. And if you're sitting there right now holding a denial letter for a small business loan and you're, wondering what you did wrong, I want you to just grab a coffee.
Take a deep breath.
Yeah, take a breath and actually hear this. Because it is not a reflection of your worth as an entrepreneur.
Not at all.
Your business model isn't necessarily broken. So today, we're doing a deep dive into a massive stack of 2026 financial and credit reports.
And there's a lot of data to get through.
There is. But our mission is to show you exactly why traditional banks have, suddenly locked their doors to local businesses.
Yeah, and more importantly, we're going to map out exactly where you should actually be going for capital instead.
Right, because getting a no right now is actually just a symptom of a massive structural shift in the economy.
And it's a shift that, remains largely invisible until you're the one running headfirst into the wall.
Totally. Because you look around and the financial headlines are endlessly praising this robust, stable economy.
The stock market looks great.
Right, it looks amazing. But on the ground, the reality for everyday small business owners is just drastically different.
It is. We're currently operating in what economists are calling a restrictive equilibrium.
Okay, let's unpack that because restrictive equilibrium sounds incredibly academic.
It really does.
So on Main Street, if I'm a listener trying to fund a payroll run or buy a new delivery van, what does that actually look like?
Well, honestly, it looks like a closed bank vault. I mean, the big statistic that really sets the stage for everything we're looking at today is this.
Okay.
Right now, a staggering 58% of small businesses are failing to get the full amount of credit they seek.
Wait, 58%?
Yeah, nearly 6 out of 10 businesses are walking out of the bank with either absolutely nothing or significantly less than they need to operate and grow.
That's wild. I mean, if almost 60% of businesses are getting rejected, my immediate instinct is that the banks themselves must be struggling.
You'd think so, right?
Yeah, like they must be hoarding cash because their own margins are razor thin and they're just barely keeping the lights on.
But what's really fascinating here is that the underlying data reveals the exact opposite.
Really?
Yeah, the banking sector in 2026 is historically healthy. If you look at the FDIC data for 2025, supervised institutions reported a massive $295.6 billion in net income.
Oh my God.
Right? That's a 10.2% increase from 2024.
Wow.
And their net interest margin, which is just the metric of how much they make on loans versus what they pay out on deposits.
Right, their basic profit margin.
Exactly.
Yeah.
That has grown to 3.39%. I mean, they are highly profitable.
Wait a second. So they're making record profits, their margins are up, but they are denying nearly 60% of small businesses. How does that math actually work? Like, how do you make more money by turning away the majority of your potential customers?
Oh, it's through what financial analysts call the credit paradox. Banks are generating these record profits specifically by not taking on small business risk.
So they're just avoiding it entirely.
Actively retreating from it, yeah. Community banks, which historically have been the absolute lifeblood of local business lending.
Right, the classic Main Street bank.
Exactly. They actually reported a 2.1% decrease in traditional commercial and industrial loan balances.
Wow.
Instead of lending to, the bakery on the corner or the local logistics company, banks are taking their massive pools of capital and lending it to credit card issuers.
Oh, I see.
And increasingly, they're lending to non-depository financial institutions. In other words, fintech companies.
Okay, so it's like a famous local restaurant bragging about record profits, but when you try to book a table for your anniversary, you find out they've stopped serving regular diners entirely.
That's a great way to put it.
They locked the front door, and now they exclusively cater giant private corporate events out of the back kitchen. You can't get a table, not because your money isn't green, but because they've found a more efficient, lower-risk way to make a profit.
Yeah, and to build on your restaurant analogy, the banks aren't just catering out of the back. They're actually lending their expensive kitchen equipment to a fleet of food trucks.
And the food trucks are the fintechs.
Exactly. They let the food trucks deal with the unpredictable, messy customers out on the street.
Right.
The banks have completely outsourced the customer risk. They just collect a safe, guaranteed fee for renting out the equipment.
So they've de-risked their balance sheets.
Completely. They leave the complicated medium-risk world of everyday small business lending to these alternative platforms. Traditional banks are perfect.
Yeah, like when a listener's application gets fed into a bank's automated system, what specific data point is triggering that immediate denial?
Well, the underwriting algorithms have severely tightened their parameters, and the data points to three massive hurdles in 2026.
Okay, what's the first one?
The number one reason, cited by 41% of denied firms, is what we call the debt overhang.
Debt overhang.
Yeah, and this is a massive jump. I mean, in 2021, only 22% of firms were denied for high existing debt. Today, it's almost double that.
What exactly makes up that debt overhang? Are businesses just recklessly maxing out corporate credit cards to stay afloat?
No, the reality is much more painful, actually. A huge portion of this debt represents the lingering shadow of COVID-19 era government relief loans.
Oh, like the EIDL loans.
Exactly, the economic injury disaster loans.
Yeah.
Many small businesses took those loans simply to survive the pandemic lockdowns.
Right, to keep their people employed.
Yeah. But now, years later, those balances are still sitting on their balance sheets as long-term liabilities.
Yeah.
So when a bank's automated system evaluates an application, it calculates the debt service coverage ratio.
Which is basically what...
It's essentially a measure of the cash flow a business has available to pay its current debt obligations. The system looks at your monthly revenue, subtracts operating costs, and sees if you have enough left over to comfortably cover a new loan payment.
Okay, that makes sense.
But because those old pandemic loans are taking up space in that calculation, the business's ratio is dragged down below the bank's new, ultra-strict algorithmic threshold. The software just flashes red.
Wait, let me make sure I'm fully grasping the irony here.
Yeah, it's bad.
Businesses in 2026 are being actively penalized by banking algorithms for taking the exact emergency relief loans that the government highly encouraged them to take just a few years ago so the entire economy wouldn't collapse.
It is an incredibly frustrating paradox.
Absolutely.
That is insane.
But from a purely mechanical underwriting perspective, the algorithm is entirely devoid of historical context.
Right, it doesn't care. It doesn't care about the heroism of keeping your staff employed during a global pandemic. It just scans a spreadsheet, sees a liability that restricts future cash flow, and automatically categorizes the application as high risk.
That is brutal. Okay, so that's the first tripwire. What is the second reason these systems are auto-rejecting applications?
The second is the thin file problem.
Yeah.
And this really hits non-employer firms the hardest.
So like freelancers, solopreneurs, very small startups?
Exactly. 45% of these firms are rejected purely because of their credit scores.
Wow.
Traditional banks have programmed hard floors into their software. If you don't have a 680 FICO score, the conversation is over before a human being even looks at your file.
Just an automatic block?
Yep. Algorithms require a minimum viable amount of historical data to predict future behavior.
And newer businesses just don't have that yet.
Right. Because many newer entrepreneurs haven't had the time or capital to build a thick, robust business credit profile, the algorithm just can't score them.
Which means they have to use personal credit.
Exactly. As a result, 48% of these owners are being forced to rely entirely on their personal credit to secure business financing. And if your personal credit took a hit while you were bootstrapping your company, the system shuts you out.
So debt overhang and thin credit files explain why new or struggling businesses are locked out, but I have to imagine even successful established businesses are getting squeezed right now just by inflation.
Oh, absolutely.
Are these underwriters looking at the cost of eggs for that corner bakery?
They are, and that brings us to the third tripwire, which is margin compression.
Okay.
Even if your debt is low and your credit is stellar, rising input costs are eating into net profitability.
Right.
So whether it's the wholesale cost of flour, rising wages, or even just more expensive software subscriptions, top-line revenue might be growing, but the costs are growing faster.
And I'm guessing algorithms hate that.
Algorithms hate shrinking margins because it leaves absolutely no room for error. To a bank operating in a restrictive equilibrium, a business with compressing margins is a business they just don't want to touch.
So we have the ghost of a pandemic loan, strict 680 FICO floors, and the undeniable reality of inflation eating our margins.
Yeah, it's a perfect storm.
But looking at our sources, it's not just the numbers on your balance sheet that dictate your fate. It's actually the physical zip code attached to your business address.
This is one of the most surprising parts of the data.
Geography is playing a huge role in these automated rejections.
Right. If we connect this to the bigger picture, Location is currently acting as a major proxy for credit risk.
How so?
Well, the national average denial rate for a loan or merchant cash advance is around 21%. But that average masks a staggering geographic divide.
Okay.
If you're operating a business in New York, you are facing the highest denial rate in the country at 29%.
29%. Why is a bank algorithm penalizing a business just for being in New York?
Because New York is incredibly dense and heavily concentrated with service industries. Restaurants, retail, boutique hospitality. These are exactly the industries suffering the most from that margin compression we just discussed, due to astronomical commercial rent and high labor costs.
So it's guilt by association.
Pretty much. The underwriting algorithms pull regional overhead data, look at the local failure rates for service businesses in that specific area, and effectively redline the entire sector's risk profile.
But the data also shows something I found totally baffling.
Oh, the Sunbelt numbers.
Yes. You look at states in the Sun Belt like Texas, Georgia, Florida. These states are famous for being incredibly pro-business, low taxes, very friendly regulatory environments.
Right.
Yet Georgia and Texas have a 28% denial rate. Florida is right behind at 27%. Why are historically pro-business states rejecting so many businesses?
It's what analysts are calling the Sunbelt paradox.
Okay.
These states are so pro-business that they're experiencing unprecedented entrepreneurial churn. In February 2026 alone, the South region saw over 222,000 new business applications.
222,000. That is an absolute explosion of new ventures.
It is, and that massive volume completely breaks their risk models.
So the banks are just overwhelmed by the sheer volume.
Exactly. When a bank's automated underwriting system gets hit with hundreds of thousands of applications in one region, many of which are startups without multi-year tax returns or significant collateral, the system flags the sector as hyper-competitive.
Oh, I see.
The algorithm assumes most of these new businesses will cannibalize each other, so it raises the baseline credit requirements just to filter out the noise.
So they aren't rejecting you because your business is inherently bad.
No, they're rejecting you because the algorithm is overwhelmed by your neighbors.
Wow.
Conversely, states like Arizona and Minnesota have the lowest denial rates, 13 and 16% respectively.
Why is that?
Largely because the local community banking networks there have managed to maintain human relationship-based lending rather than relying purely on automated scoring. And their growth is steady rather than an overwhelming spike.
Right. And we can't talk about geography and funding without talking about the structural failures that made this entire situation worse.
Oh, definitely.
Let's talk about the late 2025 federal government shutdown. Because normally when the traditional banks say no, businesses turn to the Small Business Administration, the SBA.
Yes.
But during that shutdown, the SBA was essentially frozen.
It completely froze the SBA's core lending programs.
Mhm.
And this disproportionately harmed the states that were already struggling with high bank denials.
Just a devastating liquidity gap.
Absolutely. In California alone, an estimated 212 loans were blocked per week. That represents $126.8 million in lost capital every single week the shutdown lasted.
And in Texas.
In Texas, it was nearly $89 million a week.
That is capital that businesses were counting on to make payroll, to buy seasonal inventory, to keep the lights on.
Right.
And when the government shuts down the SBA, those desperate businesses don't just stop needing money, they have to survive.
Which naturally forces them into the arms of high-interest alternatives.
Precisely. It forced a massive rerouting of where small businesses get their capital. Which brings us to the most important part of our deep dive.
The solutions.
Yes. We've diagnosed the problem. The traditional banks have locked the front door and let the algorithms bounce anyone who isn't perfect. The government occasionally shuts down the SBA.
Right.
So where is the capital actually flowing from in 2026? If a listener needs funding right now, what is the first major alternative they need to look at?
Well, the first major alternative is the fintech sector, the non-bank capital providers and online lenders. And their rise has just been meteoric.
How big is their market share now?
They now own 42% of the small business financing market.
That's huge.
It is. That's up from just 25% in 2018. Small business owners are now 2.6 times more likely to approach a fintech lender first before they even bother walking into a traditional bank.
Because they already know the bank algorithm is going to say no. But beyond just avoiding rejection, what is the actual mechanical appeal of these fintech lenders?
2 words: Need for speed.
Okay.
While a traditional bank loan requires a human underwriter to review 3 years of tax returns, a physical business plan, and collateral documentation.
Which takes forever.
Yeah, a process that can take weeks or months. But fintechs operate entirely differently. Lenders like OnDeck bypass traditional underwriting by using API integrations.
So they just plug right in.
Yep. They plug directly into your digital infrastructure. They pull live, read-only data from your QuickBooks, your Stripe account, your Shopify dashboard.
Wow.
Because they're analyzing real-time cash flow rather than historical tax returns, they can process the data and disperse funds in as little as 4 to 48 hours.
4 hours. You can literally apply for a loan after breakfast, grant them access to your digital ledger, and have the cash sitting in your operational account by lunch.
Yes, and this is a but that incredible speed comes at a significant cost.
The catch.
Right, which creates what the sources call a massive satisfaction paradox.
What does that mean?
Only 30% of users report being highly satisfied with their online lenders. 60% complain that the borrowing costs were significantly higher than expected, and a full 75% report serious issues with transparency regarding interest rates and repayment terms.
Here's where it gets really interesting, though.
Yeah.
Even with those terrible satisfaction numbers, even with the exceptionally high costs and frustrating transparency issues, businesses using fintech loans expect more revenue and employment growth than the businesses using traditional bank loans.
That's right.
It's exactly like getting a rideshare with massive surge pricing during a rainstorm. It's going to cost you way more than waiting for the city bus, but if paying that premium gets you to a $1 million client meeting on time, the speed is absolutely worth the high cost of the trip.
That's the perfect analogy. Because fintech capital is entirely transactional. It's being utilized specifically for high-velocity growth opportunities.
Makes sense.
If you need to secure a massive inventory discount that expires tomorrow morning, or you need to instantly repair a critical piece of manufacturing equipment to fulfill a major contract, you don't care about a slightly higher interest rate.
You just care about getting the money.
You care about the speed of acquisition. The cost of the capital is secondary to the opportunity cost of doing nothing.
But what if you don't want to pay the surge pricing? What if you aren't trying to fund a massive high-velocity growth spike?
Right.
What if you just need a smaller, stable injection of cash to upgrade some point-of-sale software? Or float your payroll for a month while you wait for 90-day invoices to clear?
Then you look to the Small Business Administration, the SBA.
The SBA.
Yeah. And in 2026, the SBA has executed a massive strategic pivot. They aren't just a government safety net anymore. They have fundamentally restructured their offerings.
How so?
Well, in 2025, they guaranteed a record $45 billion in loans. But the real story is how they're distributing that money.
Right, because historically, I think most people thought of SBA loans as these massive, complex, multi-million-dollar commercial real estate deals.
Exactly. But today, we're seeing the small dollar pivot. Over 50% of the SBA's 7A loans, which is their primary flagship program,
Right.
are now under $150,000. Over 80% are under $500,000.
Oh, wow.
Entrepreneurs are borrowing much more conservatively. They're using these smaller loans for incremental upgrades, working capital, and small technology investments.
It's much more accessible.
This shift has made the SBA the absolute perfect alternative for the smallest firms, businesses with just 1 to 4 employees, which are the exact businesses that traditional banks have completely abandoned.
And there is another massive pivot the SBA has made specifically targeting industrial businesses.
Yes, the Made in America Manufacturing Initiative.
Right. For domestic manufacturing firms, the SBA has essentially rolled out the red carpet.
They really have.
In fiscal year 2026, they completely eliminated lender fees to aggressively lower the cost of capital for industrial onshoring.
Which is huge.
Yeah. They proposed doubling the maximum loan limits from $5 million to $10 million, and they launched the Amogo portal.
The Mogia portal, right?
Yeah, which is a dedicated centralized network connecting domestic manufacturers with domestic suppliers to rebuild local supply chains. It already has tens of thousands of active users.
This raises an important question, though.
Yeah.
If traditional banks are hoarding cash and outsourcing risk, fintechs are charging surge pricing for API-driven speed, and the SBA is focusing on small dollar loans and manufacturing. What are we actually looking at here?
We're looking at a total structural realignment of capital in the United States.
Exactly. It's a trimodal system now.
Right.
Traditional banks are for massive corporate loans, established businesses with flawless credit, zero debt overhang, and tangible physical assets.
Okay.
Fintech is for high-velocity, fast-moving growth, where speed is more critical than the cost of capital. And the SBA has become the ultimate stable engine for small, incremental working capital and the resurgence of domestic manufacturing.
So what does this all mean? If you're that listener sitting there with that formal denial letter from your bank, the most important takeaway from this entire deep dive is this.
Yeah.
Getting denied by a bank today is just a single data point in a market that has fundamentally shifted under your feet.
It really is.
It is not the end of the road. You haven't hit a dead end. You just need to reroute. If you need speed, if you have an immediate growth opportunity and you can absorb the higher cost, you look to fintech.
Yeah.
If you need smaller, stable working capital to make incremental upgrades, or if you're anywhere in the manufacturing space, you look to the SBA. You just have to know which door to knock on.
And, we've spent this entire deep dive talking about how rudimentary underwriting algorithms are currently locking small businesses out.
Right.
But the final critical piece of this puzzle is what happens when those basic algorithms are replaced by true artificial intelligence.
Oh, wow. Yeah.
It is entirely rewriting the rules of underwriting as we speak. Right now, 80% of surveyed fintech companies are actively implementing AI across their business domains.
80%.
Yes. What's happening is a rapid, permanent shift away from static historical metrics like that 680 FICO score or last year's tax return
Right.
toward real-time AI cash flow analysis.
So the AI isn't just looking at what you did 2 years ago. It's looking at what your bank account did this morning.
Exactly. Lenders are using machine learning to instantly analyze your daily transaction data, your point-of-sale systems, your real-time revenue streams.
That's incredible.
It allows them to offer faster, highly informed decisions, bypassing the traditional thin file problem entirely. But it also means that your daily operational data is constantly being evaluated by the machine.
Which leaves us with a fascinating and maybe slightly intimidating thought to mull over.
Yeah, definitely.
If traditional human underwriters are stepping back and AI is about to replace human decision-making entirely, your future access to capital all comes down to the data you are feeding the machine.
It's all about the data.
So as you throw that bank denial letter in the recycling bin today, ask yourself, how can you start optimizing your business's real-time digital footprint right now, today, so that tomorrow's AI looks at your cash flow, analyzes your data, and sees an absolutely undeniable yes?